U.S. inflation in March rose by the smallest amount in almost 2 years, marking a 5% on-year increase. So what does slowing inflation mean for the U.S. Fed's key rate decision down the road and for South Korea's central bank? Our economic correspondent Shin Ha-young takes a look.
U.S. consumer price inflation eased more than expected in March. According to the U.S. Labor Department on Wednesday, the U.S. Consumer Price Index last month rose by 5% on year. This was lower than Dow Jones' estimate of 5.1% and marks the lowest annual increase since May 2021. However, core CPI, which excludes volatile food and energy prices, rose 5.6%. On Wednesday, minutes from the March meeting of the FOMC showed that despite indications that the U.S. could suffer from a mild recession in the second half of the year, it still decided to raise its rates, albeit by just 25 basis points. Some FOMC members cited the collapse of Silicon Valley Bank and the impact on the overall banking sector as the source of the mild recession to come. Meanwhile, one expert forecasts that the Fed will still raise interest rates next month to stabilize prices.
Despite the slowdown in consumer prices, core CPI is still high enough that the Fed may raise interest rates by 25 basis points in May.
If the Fed raises the rate next month by 25 basis points, it will widen the gap in rates between South Korea and the U.S. to 1.75 percentage points. This could put the pressure on the Bank of Korea, which recently decided to leave rates unchanged. But the expert says with the exchange rate stable, it's not necessary to follow Fed this time.
Capital outflows are related not only to a gap in interest rates, but also to exchange rates and the state of the domestic economy. Considering these factors, if South Korea's economy and exchange rate become stable, there may not be a significant concern about capital outflows, even if there is a rate gap between South Korea and the U.S.
Considering South Korea's slowing inflation, he forecasts that interest rates in Korea will remain unchanged. But the BOK could raise the rate if the exchange rate goes up and import prices increase, causing a rise in inflation again. Shin Ha-young, Arirang News.